Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora koutou and welcome to another week of Markets, Mystics and Mayhem, and the mayhem in markets has continued. We've seen an extraordinary week in financial markets, some extraordinary announcements from Trump and others, kept us on our toes, kept things exciting. You may have noticed in our episodes, we try and sort of keep things a little bit more evergreen. That's the word, isn't it? Yeah, we try not to date ourselves. No luck this week. We are recording this on the 14th of April, and a lot has happened and a lot will happen in weeks to come. The one thing that I like looking at as a gauge to what's happening in financial markets everywhere is the Kiwi dollar. It is a risk currency, it is a commodity currency, it's a growth currency, it's a proxy for Asia. Basically, it moves up and down with risk appetite. So in good times, the Kiwi rises, bad times, well, you'll find it on the floor somewhere. And what we saw last week was the Kiwi dropping from the mid sort of 58 into the 54s, and then it bounced right back again, back up into the 58. So a massive move in just 1 week, all on the back of tariff announcements. And we're going to go through that, I think, in this week's episode. So to kick things off, Sabrina, what was announced? What happened? It was a mad week.
Yeah, it really was. I think it's been quite a bit of a round trip. So last week, Trump came out and said he was going to put a 90-day pause on all of the reciprocal tariffs. That doesn't include that 10% baseline, but all those additional, anything above that 10%, that's been put on pause for 90 days for all countries except China. They continue their sort of tit for tat retaliation with each other. I think as it stands right now, as of this very moment, China has, I think the US has put 145% tariff on China, and China has retaliated with 125% tariffs on US imports. So quite hectic, but I guess looking to some good news though, over the weekend we also heard Trump announce that some electronic goods would be excluded from the reciprocal tariff. So things from cell phones, computers, semiconductors, microchips, things like that, that's being excluded as well.
Yeah, it's interesting. I think we're going from these blanket kind of statements to getting into sort of specific goods. I think you probably read the articles that have been out that the iPhone's going to double in costs. So, we better do something about that.
Yeah, it really does expose how much the US uses everyone's resources around the world. But I think from last week, what we gathered was, one, how fast moving this all has been. Like, this is a week, and you mentioned that they made all these changes in a week, and you saw markets really just go up and down pretty much. But then also I think we learned from last week kind of a glimpse of what this might all end up looking like you were saying. It's not going to be, hopefully, this kind of blanket big high-level tariffs on China. You'll be more specific, drill down to those ones that they really want to kind of target. I think that's kind of what this will... I mean, it's very uncertain times right now, and it's hard to, make scenarios and everything, but I think that might be what this all settles down and looks like.
Yeah, I think it's what we said last week. It's that sort of typical Trump, come out strong, ultra aggressive. Here's these massive tariffs, and of course everyone shakes. And then they get to the negotiating table and end up with something quite different. So, I think we're just sitting here waiting and watching and seeing how these countries negotiate. Trump was quite proud of the fact that sort of 75 countries had dropped to their knees and sort of kissed the ring of the emperor. I'll do whatever it takes to get a 10% tariff rather than a 50% tariff. And I think that continues.
Yeah, and I guess from an outside perspective as well, we're now talking about, all right, negotiations seem to be underway, and it seems like Trump is maybe, slowly kind of letting go of a few things. So in that sort of scenario, do we think, are things actually going to go back to the way they were, or are we still, seeing the rest of the downside? Because we talk about how right now things are so ever-changing that it's hard to come up with scenarios, but we have given it a go, right? So we think today it's good that we talk through the upside, the central, and the downside scenario. So upside right now is that, hey, Trump is maybe good negotiations take place and they happen quick. What do we see happening then? Is it just going to be life as per before tariffs then?
No, we're not going back to life before. There's a new sort of world here where the US is simply taxing and doing a revenue grab. And the way I think of it, 10% is a revenue grab, 50% plus is actually trying to destroy that market and divert goods. So I think a lot of these countries will end up with a tariff closer to 10%. And if we're to dream up the best case scenario, it's that Trump just keeps stepping back, makes a whole lot of deals. The deals are done. Most of these countries walk away with a 10% tariff, and hopefully in a month's time we're talking about other things. I think that would be the upside. But even then, global growth is a little lower than what it was.
And even
otherwise.
in the upside scenario, you don't necessarily see China getting all the way back to 10% either, of course,
definitely
right?
not.
Same with the EU.
Yeah, absolutely.
Yeah.
Yeah. So what's our central scenario? I think the central scenario is basically kind of the upside, but takes a little longer, and maybe, tariffs are still a little higher across certain countries. So we're talking months, not weeks of negotiations, but we do kind of come out the other side. Again, global growth is weaker. We've had uncertainty in markets for months, not weeks. But we come out the other side and, global growth's a little weaker. The world's simply a little weaker, but we're not slashing interest rates. We're not intervening in markets. We're just kind of, muddling through.
Yeah, I think the big difference between a central and any upside scenario really is just the timing of when all of this volatility, uncertainty kind of, ebbs away. If it is all kind of wound up and he completes all the negotiations, which apparently he said he can do
In a day.
in a day, he can do that all
Yeah.
in a day. If that does play out, then I think our base case scenario of a recovery in the New Zealand economy, I think, kind of still suits for this year. But so long as that volatility just continues and uncertainty continues, businesses aren't going to it's hard to invest in these times. So that alone can that uncertainty alone can really delay the forecast rebound we have.
No, and that's what we're hearing from people and customers, right? I was presenting to a bunch of property investors, and that's just another issue with them. A lot of questions around Trump and trade and what it means, and sort of bringing that back to the New Zealand property market. So it's a bit of a stretch, but still, that uncertainty kills growth. It really does. It stops people from making that investment. It stops businesses from expanding, and it stops them from hiring. So yeah, the economic uncertainty lingers, and it's certainly not helpful.
Yeah.
And I mean, that's why in our central scenario and our upside scenario, but we have sort of changed our call to say actually the cash rate, and we've flagged the risk already, but we did officially change our call to say, we think the Reserve Bank actually needs to go below a neutral 3% and actually to 2.5% to actually, counteract that really negative sort of pullback from businesses in these uncertain times.
Yeah. So unfortunately, we've gone back to where we were. So we were calling for a 2.5% cash rate right up until November last year. The RBNZ wrong-footed us again by coming out with a hawkish statement, and we sort of said, okay, fine. We still think that 2.5 is appropriate, but it looks like they're only going to 3. Well, now these developments, I think, cement a move below neutral, which is 3, and to 2.5. And as soon as we start talking about downside risks, well, we can go anywhere really.
Yeah, because if you look at our our base case scenario, it's still there's by no means it's a guaranteed recovery because we're crawling out of a recession, but that's mostly off the back of a strengthening in the external sector. Agriculture and tourism. They've really been the kind of shining stars in all this, but they're obviously the most exposed to what's happening overseas. So if you see a slowdown there, a slowdown in global growth, then it leads to a slowdown in the external sector. So we see that kind of just filters through, and it just forces a delayed rebound.
Yeah, I think it's worth mentioning again, like we did last week, our direct trade with the United States probably doesn't get much of an interruption at all, really. I mean, it's a 10% tariff. The currency could be lower still, and we're exporting beef and wine and that good stuff that Americans love and will continue to import from us. So I don't think the direct impact is much at all, but geez, the indirect impact via a slower China, via a slower Europe and Asia more broadly, that'll definitely have an impact on our other exports, including the services, right? Tourism.
Yeah, we're exposed.
So if our upside is not much higher or better than our central scenario, where do all the risks lie? It's clearly to the downside, right? So what happens in a downside scenario, or the mini?
Depends how far down you want to go.
Yeah,
Because I feel
exactly.
like there really is no bottom when it comes
No.
to, and it gets pretty like upsetting the more you sort of think about how far it could really go. I guess,
Yeah.
keeping things on just a tariff scale, it's just slower global growth and the Reserve Bank or central banks in general needing to do what they need to do and basically going into whatever it takes mode. And whether that's, that will be cutting a cash rate, to 1.5, even lower, if whatever is really needed, we know that central banks can step in when they need to. I thought our conversation on Friday around, what other alternatives outside of the cash rate the central banks could sort of implement if things really turn to the downside was quite good.
Yeah, so I think in downside scenarios, however that plays out, whether China and the US continue to go head to head, the US attacks Europe, and we do see these paused tariffs of 10% go back to something closer to the initial announcements. That is very disruptive for global trade and supply chains. It's a supply shock. That's gonna ripple through economies around the world. Much lower global growth, which means lower commodity prices, which means a simply weaker Kiwi outlook. Given most of the upside has come from our external sector, to have that have a terms of trade shock, just changes the game. So yeah, you're right. Central banks, I think, will mark the bottom in the market, wherever that may be, and that will be them slashing interest rates. Firstly, that's the obvious thing. And when I mean slashing interest rates, it's not 25 basis point moves, it's 50 basis point moves. And if markets really seize up, then they can do 100, 150, whatever's needed. You do the sort of Mario Draghi, whatever it takes. And the whatever it takes goes beyond moving a cash rate lower. It actually goes into bond markets, which might be seizing. Even government bond markets might be seizing. We saw it during COVID. We saw it in 2008. And central banks have learnt that, using a little bit of QE, printing a little bit of money to buy bonds as a buyer of last resort works. So they'll come in. They may even buy other assets like council bonds or LGFA or other things in the market just to get interest rates lower. And once all of that happens, that's when you'll see, I think, the larger, more savvy investors who have probably kept a bit of powder dry. That's when they start piling in. It's like, okay, the central bank's done what it takes. We will see one hell of a bounce in financial markets, like we saw during COVID, like we saw in 2008, following the 2009, following the 2008 crisis.
Yeah. So I guess in all of this uncertainty and confusion in terms of headlines, is it central banks that we should be looking to for any sort of like firm guidance as to where to go from here?
I think we watch markets. Obviously we're watching the developments around the tariffs, how that translates into markets. If we're going down these downside scenarios, then that'll play out in markets. Once we start seeing dysfunction, like illiquidity and markets breaking as they do, that's when central banks will step in, and you'll see a combination of rate cuts with the one hand, purchasing with the other, until they steady the ship.
Yeah.
And that could be a month away, it could be 6 months away.
Yeah.
Should I hit a soft spot? What about negative rates?
Oh, don't go there again.
See, soft spot hit.
Yeah, I know. Ouch. I fiercely disagree with negative rates, and I think the areas that had negative rates aren't convinced that they worked. There's been some good research out there that shows you that as interest rates go lower and lower and lower and lower and lower, it actually forces people to do the opposite. Yeah. So you'd think that lowering interest rates forces people or encourages people to spend more, or actually once you go really low, people actually start saving more because they're just getting nothing on their savings, so they have to save even more. So the jury's out as to whether negative rates work. I'm of the belief they don't.
Yeah.
Are you going to say they do?
No, I'm not. I was going to say, like, actually, Japan is probably a good example. They had negative rates for a very long time, and they've been in a very low inflation environment. It's been hard for them to get out of and actually see us, household demand consumption rise. You're seeing a bit of it now, but I think that's a classic example of how negative rates aren't exactly going to work out the way that you would expect it to or hoped it would.
A lot of people point to Japan as a good example. Japan is an example of people's mindsets changing, and that's the scary bit. So you might have a negative rate, you might have negative, deflation. If that persists, then you expect it to happen, and people forget that we've all got a price on our heads. Your income, my salary. That's our price, and our price declines as well. And in the Japanese case, the price of the wages, the salaries fell more than the price of goods and services, and it was just messy for a long time. But people started expecting that. You talk to any central banker, what would you rather face? A period of slight deflation, or a period of high inflation? They would rather face a period of high inflation because they know they can bring that back down. But persistent deflation is very hard to get out of.
Yeah.
We're not going there, though. How did you take us there? We were talking about
the people
cutting the cash rate.
No, that there was an option that was considered during COVID, right?
Was it ever?
Yep. So you can't discount it. I mean, I know that you stand against it firmly. We think we all do. But when you see things like, for example, how the market has responded, I know a lot of it's pared back now, but you saw like the VIX going up, breaching above 50, which has only ever happened 3 other times in history, one of them being COVID. These questions might come back in people's mind about whether does this call for negative rates. So it has to be asked.
Yeah, it does. And I would hate to say that or suggest that, if the worst of our downside fears come through, then we could be in a very different world at the end of this year. And everything could be on the table. So I guess what we're saying here is our central scenario is that we kind of muddle through this and we end up with a cash rate in New Zealand at 2.5, which is where we've kind of said it needs to be all along. Very slight upside risk to that. Not a lot, really. We still think 2.5. Most of the risks are to the downside with very heavy, uncomfortable probabilities assigned to them. So if we look at Kiwi rates and we were positioning in Kiwi rates, I would still be positioning for much lower interest rates. And our 2.5 rate call is below market expectations. So even our central scenario suggests there's further downside for interest rates in New Zealand. And then, of course, we've got all these downside risks. So being positioned basically in bonds for lower interest rates in this world is probably the best way to be. Okay, so in our weekly, which if you want a really good publication that comes out every Monday, reach out. We'll chuck you on our list. This week's weekly, we put a bunch of charts together, just given all the movements in markets. What did the VIX do? You've said it just before, but say it again.
So it breached above 50. Well, first of all, the VIX is the volatility index, basically measuring sort of the panic in markets, I guess, a little bit. And so it breached above 50, which it's only ever done 3 times in history. It's going far back as to 1980s. Yeah. The 3 other times was during was it Black Monday?
Black Monday in 1987.
Yeah, see, I wasn't around then.
That was pretty bad. I was 10.
Yeah. The other 2 times, the GFC and COVID. So, that's just showing you how disruptive and how, I guess, like cataclysmic Trump's sort of change in tariffs, not even change. So when he first implemented them, how drastic that was able to sort of change markets' perspective of a new world, basically.
Yeah.
So unprecedented. So that's the VIX.
So VIX, kind of like the fear index, spiked massively.
Yeah.
What was your other favorite chart?
I think watching gold has been pretty fun at the moment. So basically with, US assets seeming quite risky right now, we are seeing investors retreat back into, typical traditional safe havens like gold. Gold's doing pretty well.
Gold's been an instrument that you sort of jump into when you're really panicked and you disagree with fiat money so there's been a bit of central bank buying, I think, that supported that, but I think we're seeing more and more wholesale and retail investors going, actually don't like dollars anymore. Buy gold.
Yeah.
It breached above 3,000, didn't it?
Yes, yeah. It's like 3,200 or something.
Yeah.
Big move. What was the other one?
MJ, you helped me out on some of the charts. I think there was one on US Treasuries, 10-year Treasury. That one was interesting because it's kind of done a full circle.
Yeah.
Yeah, I think what you talked about, people buying up gold as a safe haven asset. Usually in times of risk as well, you flee to US Treasuries, and you see the 10-year, the yield on the 10-year specifically as a benchmark rate fall. We saw that initially, but then unexpectedly or kind of unusually, we saw it start to rise, and it's kind of getting close to, it's not at 5%, but it's getting close to those highs, which is not what you'd expect. People are dumping risk, and you'd think that they go to the safest, government debt out there, which is the US, but it seems like they're kind of fleeing that as well. And as JK is our unofficial interest rate strategist, what do you think about that?
Yeah, you've got
I think there's some sneaky selling in there. I think if you want to do a little sucker punch to the US, you go, all this talk of tariffs is great, but by the way, we're dumping treasuries. And I think we saw that last week, although we can't confirm it just yet. You're right. The initial move in treasuries is exactly what you expect. We saw this massive rally in treasuries, which pushed their interest rates down. But then there's this selling pressure despite the madness in markets, and quite a move higher. So I think there's been some dumping behind the scenes. And even if there wasn't, there was talk of it, which probably caused other people, other investors to dump it. So massive moves in treasuries. Yeah, more of the other charts.
The other one was, not only is US Treasuries getting dumped, but also the US dollar isn't as strong as you'd expect. Part of the reason why, yes, the whole, rollback in tariffs is good news for the global economy, but also I mean, it's still a pretty risky time, and you'd think that the US dollar would be stronger. But part of the reason why the Kiwi's back up at 58 cents is because they're kind of moving to other currencies, the Swiss franc being one. Euro is also getting a bit of strength because it seems like that area is kind of uniting, and you're seeing a bit more strength and, flow to the euro. So it's so interesting to see that in a week, the currency has gone down to as low as 54 something to back to 58.50 or something. There obviously is something to do with the dollar being hammered as it is.
There's cracks beneath the surface. There's talk of dumping treasuries. Oh, that's interesting. In a really heightened uncertainty, and talk that the dollar is not quite as strong as it should be. It's not quite that reserve currency that it used to be. There's so many articles out there about people getting out of dollars. So just cracks, cracks beneath the surface. So how many was that? 4? Well, we had 6, didn't we?
Oh, just so many.
It was an oil chart.
Oil was interesting. Again, it kind of fell, I think, mostly because of implications of what this could mean for the global economy. Again, you'd think that maybe it would rise because this could go beyond just a trade war and actually go, military or something. And then you'd see maybe more buying up of oil, but not quite this time around.
Yeah, and I think that will reflect commodity prices in general. So commodity prices go up and down basically with global growth. So if we've got strong global growth and everything's pumping and everything's humming, commodity prices are rising, whereas the reverse happens in bad times, unless it's an oil-specific shock.
Yeah.
We should see oil prices and other commodity prices coming off on weaker growth.
Yeah.
Was there any others?
There was one more.
There
was an equities chart with the S&P 500 index and also the NZX, which, I mean, as you'd expect, they've both been sort of down in dumps. I mean, there has been a bit of a recovery since Trump kind of put that pause on, and I'm sure following the news about some of the tech being excluded from reciprocal tariffs. But I don't know, if you look at your sharesies, if I look at my sharesies, it's still pretty sad. So I think there's still, in these uncertain times, I don't think we're going to get a full recovery anytime soon there.
No, that's right. It'll take time.
All right, I think we can wrap it up there. No doubt we'll talk about this volatility next week again, just with everything that's happening. But I think for us here in New Zealand, domestically things look like they're okay. But obviously it's our external sector that's really exposed to what's going on overseas. And if we see a global growth slowdown, which seems to be where the risks are tilted, that obviously doesn't bode well for us as a small open economy. So we're keeping watch on things very carefully. Downside risks?
Well, I think, given everything's so unprecedented and changing all the time, now's a really good time to follow, subscribe, and like along so we can keep you updated on this ever-changing journey.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.